Kathryn, your take on the Fed?
Yeah, certainly it was extremely dovish. I think we continue to reside in a Goldilocks scenario in the U.S. economy. I don't agree with the previous guest that we are close to recession as yet. I don't have it forecasted in the next 12 months at all. We follow many leading indicators at Bulltick Research, and our models show a very low probability of U.S. recession. So I think the combination of very low inflation, near full employment, and economic growth really lends itself to dovish policy. And is the reason why at Bulltick we were bullish and recommended long positions at the end of last year, both in U.S. equities, but even more so in emerging market equities. And I think that's where you're going to make the most money this year.
Kathryn, you're not concerned about the downward revisions to GDP, as more of a material problem?
Well, sure, but potential growth in the U.S. is 2.2%. Last year, the U.S. grew nearly 3% year over year. This year, we're forecasting still above the 2.2% potential rate of growth. So, no, I'm not worried about the forecasts. I think that we are still growing at a very nice clip, even though it's at a slower clip than it was last year. The dollar came down, treasuries rallied. That's all good for risk taking. And I think that if you look at total investment, Jackie, that's kind of the component of GDP that I've been most reflecting on for the past several semesters has been really recovering. So I think total investment, consumption, private investment is all positive and moving higher.
Okay, so John's point of view is markedly different. So
yeah, I guess Yeah, absolutely. And for us, there are a lot of downside risks out there in the economy. And we could go through the China, Brexit, we could go through Germany barely averting a recession, whole variety of other things. But the reality is we had a very sharp tightening of financial conditions at the end of the year. In response to that, the Fed capitulated. They've gone from significant number of hikes, ongoing tightening this year to we're flat. And the name of the game in all of global macro right now is, will the Fed have averted a global synchronized downturn? And there's a lot of negatives that are still out there in the market. You look at some of the retail sales numbers, which were completely abysmal to the point people didn't believe them until they were confirmed and started to be reflected in other data, in addition to the shape of the yield curve. And frankly, we're just seeing a lot of very late cycle behavior across a variety of sectors in our estimation.
Okay, thank you for that, John. Joining us now to talk even more about what we've heard from the Federal Reserve thus far, President of the American Institute for Economic Research, Edward Stringham. Your reaction to what we're seeing here, it does sound a little bit like the Fed gave the markets a Goldilocks decision today.
Yeah, they kind of changed course. So a few months ago, they were predicting towards the end of this year, the federal funds rate was going to be upwards, approaching 4%. And now they're saying, no, we're basically going to be keeping it at the current level. So that is a market change. Now, one thing that's interesting is they can influence rates, but they can't completely determine rates. And current rates are determined, including by current policy and also past monetary policy. So I do find it interesting that they've changed course and they are actually saying, no, we're not actually going to be going up to what I would say are more normal interest rates. I think we're still coming out of a long period of historically abnormally low interest rates.
Interesting. Adam, I feel like you want to...
Well, I'm trying, if we still have Kathryn.
We do.
Kathryn, I was curious because I listened to all the people who come on Wi-Fi, and I'm curious why you seem more bullish on the economy and want to dismiss the discussions of potential recession. If that's the case, why are we watching the Fed throw on I'm going to call it the emergency brake. You might just say the brakes.
End of last year, we had that nearly 20% correction, Adam, and at that point, what was really being priced into the market was the perfect storm, a combination of variables. The trade war being basically an apocalyptic scenario, taking down global growth and certainly U.S. And that's when we got to talk. That's when it became very, very fashionable, let's say, to talk about U.S. recession. So December of last year, I remember getting questions all over the media from my clients, both institutional and retail, about risk of U.S. recession. So we have many metrics to look at, but the ones that we look most closely at, I would say 11 leading indicators. There's really only one that's giving me a yellow flag. Even the shape of the yield curve, let's look at that one. Who cares about the fives, tens, or the twos, fives? That's so near term and it's so manipulated by what the Fed does. Let's look at the twos, 30s. The twos, 30s is now steepening. It's at 55 basis points. It's been steepening year to date. Leading indicators are still positive. We haven't had one recession in the United States in the past 60 years where leading indicators were not negative year over year. There's a myriad of indicators that we look, and I just don't see it as a real possibility in 2019. So that's why we recommended long positions in the market in December, because there was this inordinate preoccupation with trade war, U.S. recession, and the Fed. And what we said at that point, and I think we're pretty much on target now, is the Fed's going to stay on hold. You know, the U.S. is growing with no inflation. The Fed has reached both of its targets. It has a dual mandate. It's reached both of them, inflation and full employment. And there will be some trade accord with China. And I think that's really market consensus now, and that's what you're seeing reflected in prices.
I'm just curious because I listened to what she says. It sounds legitimate, but are you looking at the 230 or the 210? Because the trend on the 210 has been consistently down over the last year, and it's only, about a 16 basis point spread at this point.
Yeah, absolutely. I mean, you've seen one of our favorite expressions of the end of the cycle is actually 530 steepening. And you've seen that inflect and play out in recent months. I'd also point out there's a lot of research that's gone into what curve spread is most informative as a recession indicator. And according to the Fed, it's 3-month tens. And so that's one of the reasons we watch that. Even if the market's focused on 2-year tens, that's one difference. And then I guess one other thing to keep in mind is if we're in an accelerating growth cycle, we'd expect real yields to be going up. This is a narrative we saw play out in Q3, Q4. You saw 5-year real break 1%. Since then, they've dropped back down to 50 basis points. And if the Fed is thinking about being on pause at 240, take out 2% inflation, that's 40 basis points as a terminal rate. Suddenly 10-year real yields, 70, 80 basis points, 30-year real yields, 110, 120, look really, really attractive. And we look for that to start falling at some point.
That's an interesting point.
Yeah. Can I jump in there, Jack? I think it's also important to take into consideration that we are expecting a deceleration. It's not an accelerating economic cycle. We are in the late stage. But that's, I think, in our view, is different from saying that we're on the precipice of U.S. recession or that it's even close in the next, let's say, guys have been asking me the next 6, by year end. I don't see it by year end. It could come in the next 2 years, of course. There are some yellow flags out there, but I certainly wouldn't say that we are on the cusp of U.S. recession.
Okay, we are approaching the time that Powell is going to come out. I may need to interrupt you, Edward, but I feel like you
want to
react as well.
I just want to point out that we are at record low unemployment rates. We're also kind of at record high stock prices. So sure, things could go bad, but at least right now, they're going quite all right.
No, I mean, it turns out there's something Bill Dudley used to quote, which is when the 3-month rolling average of the unemployment rate goes up 0.3%, every time since World War II, we've gone into a recession. If we're at record low unemployment and it starts to tick up, this is something to be watching very closely.
And what do you think? How do you think this could play out?
I mean, this is one of the big stories that's going on in the market right now. It seems increasingly consensus, to the other guest's point, that a recession need not be a 2019 story. It could still be 2020, but that justifies a preemptive pause for the Fed right now. Expect lower for longer and a flatter curve. If not, the Fed going back to zero and another QE program in the next few years.
And it would be interesting if it was 2020 because that's an election year.
It's an election year, and you know that you're going to have the politicians talking about the Federal Reserve, but perhaps in a way that isn't reflective of what's really happening there. It's more in the sense of what's happening to the consumer.